Hi everyone, it's Friday, and of course, you're now watching the Awesome 10x Global Market Free Friday class. This is Nikki Yu, also known as Faces Trader. And if this is your first time, I would like you to know more about the global markets and how you can make money in market crashes. Today's market title is If You F Around, You Will Find Out. So let's begin. Let me now present the realities happening in the global markets and the opportunities to make money off of these. So let's begin. Okay. Yeah, so today's November 18. I do want to explain that next week I do have a face-to-face interaction to anyone who wants to watch. The title would be Don't Panic, but How to Save Your Finances and Profit from Market Crashes in the Worldwide Recession. I'll be going to discuss 9 a.m. to 12 noon. That will be 3 hours. We'll be meeting face to face at Three Squares Bar and Cafe. This is in the Science Story, the alley. And that would be in Makati. You could register here, bit.ly/awesome10x inner circle. It's going to be 3,000 for per person, but there will be a 1 month free, inclusive of a 1 month Awesome 10x membership where we could actually help you be attuned to the worldwide US markets and how to actually profit from crashes. How do you actually have inverse funds and so on. Okay, so this is your S&P 500. Let's begin. You've got this blue line here, which is the 200-day moving average, and you've got this red line here, which is your 125-day moving average. So far, the market is trapped between 390 and 4,410. And we argue that these rallies are obviously bear market rallies, which you should be avoiding and don't drink the Kool-Aid. This market rally will fizzle out. Of course, we did the same thing around April here. We did short here. Also around December 2021, we did actually give a short collapse here. So here was a short. This was also a short. Recently, we said around 4.3 that even at 4.5, even if it rallies to 4.5, that would be a massive short call. And here again, from about 3,950 until 4.1 or even 4.2 or even 4.3, these are all shorting opportunities. Another look here would be the market breadth. Thanks to point blank trading sharing on November 17 last night, you could see that the markets have oversold, gone to an overbought condition. We did go oversold here around September 23 until October 16. And we are nearing overbought levels here where S&P 500 stocks that are above 50-day moving average, a sign of market breadth, seems to be topping out. We are nearing the previous top yet again on August 16. And so we remind you to be very, very cautious. Also, are we really close to a bottom? The answer is no. As we can see, this is not even remotely close to a bottom. The true bottom comes after everybody panic sold so hard, such that the 200 days simple moving average breadth would stay 10% below the trough. This happened in October 17, 2008 until March 2009. So from October to March, the markets kept on going down. You can see that the S&P, this is the S&P 500 during the global market crash. If you have huge spreads like nowadays, you're actually at near-term tops. And this is how your SPY today is. Between your 50-day and 200-day moving averages, it is very, very far and wide. And so what you are seeing is simply an oversold play going to a more overbought play, but still with huge spreads. That means that you are still on a cliff dive move similar to the 2008 to 2009 global financial crisis. Now take a look at your 5-day, 10-day, 15-day, 20-day. Yes, they are all overbought. All of the short-term moving averages are in the overbought territory, which simply says that you have a short covering squeeze. We have not seen fire sale levels of panic. Nothing has yet broken down to a contagion point wherein it's time to buy with reckless abandon. None of that has happened, so remain cautiously bearish. Current market rally is a testament to the CPI, PCE, PPI, and how much that affected market psychology and positioning. So we've been rallying based on just the CPI inflation expectations. Now, because of that CPI, let's discuss. It would have been fine if our oil crisis is temporary. Alas, everybody was happy with that 7.7% lower than expected inflation. However, you figure out there are still 500 million barrels of oil that are needed to be replenished because of the strategic petroleum reserves. So take a look at the 1973 to 1979 oil crisis sparking inflations. Well, in the 2022 energy crisis, it is the same. We have the percentage of countries with greater than 6% inflation. Yesterday, UK just came out with 11.4% inflation. So for them, for people who are screaming that inflation has peaked, that is too early of a sign. You've got a lot of data points that are not actually saying the same thing. Similarly, over the last 20 years, your global crude oil stocks are at their lowest level for 2 decades, with the current draw being the most extensive and swift since the data became available in 1984. This research, of course, comes from Eric Natal, 9 Point Partners, and you can clearly see that our total petroleum inventories are very, very bad. It means that we don't have a lot of oil supply. You've got the US Big Three, crude, gasoline, distillate inventory deficits versus your 4-year average. You are at the 330,000, or this is 330 million barrels of deficit, guys. So we are really in a very difficult situation given that the Democrats, after losing the Republican House, is already saying that, number one, they cannot artificially depress oil prices. And you really have a lot of problems if you think about the Chinese reopening next year. So where will we get all that oil? And if the world needs oil and there is low supply, basic economics tells you inflation is going to go rampant, still high. So you've got, of course, everyone still betting on energy crisis continuing to go up. And this is your big oil companies, the top 3 oil names in the world. And you can see that Chevron, ExxonMobil, you've got all of them going up. Total, British Petroleum. So here is just a snapshot move. From 160, it rallied to 780. Went down here to 200 because of an artificial strategic petroleum reserves owing from the US, where your $120 oil was down to about $75 oil. Now, of course, the world is not sleeping behind the wheel, and they know that oil has inevitable rise. So from about 200, it's now 600. Sure, it can go drop to 500, but every dip on oil has been remaining just a buy all throughout. June, July, September, every dip of oil has just become a gift to all the oil bulls in the world. I'd have to say that Sandridge at 18, if it will ever drop, is a good entry. Our argument is never stop buying oil. If you want to keep winning, the only winners on the long bias side are oil and energy gas companies. So you've got a lot of buyers here at 14 that got retested for Sandridge, another retest here at 14, perhaps a retest here at 16 or 18 for Sandridge. But overall, the fundamentals of all oil and gas are winners. Now, let's understand the fear and greed index. We went from extreme fear to greed, although I cannot say if we're going to hit extreme greed. Greed to extreme greed are all signs of selling, guys. So let's take a look. That was 1 month ago. We went to fear. Actually, we even went to extreme fear. So market momentum right now, we're hitting 4,000. We are still here wherein people can still be fearful. We can still go for 142, but this is actually not a stage to buy. Now, stock price trend, a lot of 52-week highs versus the lows, net new 52-week highs. That is extreme greed. Actually, these movements are just a percentage. A few big stocks can skew returns for the market. This is showing the number of stocks on the New York Stock Exchange at 52-week highs compared to those at 52-week lows, meaning a lot of stocks still remain 20% off the highs, 25% off the highs, and they're not near their 52-week lows, which tells you that there's still extreme greed in the market. Similarly, from stock price breadth, as you saw, a lot of stocks today are at the overbought region, which is showing extreme greed. Put and call options are also showing us that it's in the extreme greed phase, where people are keeping the call options to hit 4,000 for one and for two for your S&P 500. Now, in terms of safe haven demand, stocks are riskier than bonds. A lot of people continue to park in stocks rather than treasury bonds, which shows to us extreme greed still happening in the world. Now, there's some fear on junk bond demand, and people are, of course, not buying junk bonds because they know that they're not going to get paid there. But you can see that there's very few spots that the market is willing to be fearful. There's still a lot of safe haven demand wherein people continue to be buying stocks rather than bonds. Now, if you just think of this year in terms of ETF, what is up this year? Energy funds, very clearly, XOP, XLE. You've got a lot of US dollar up funds, which is UUP. A lot of inverse funds, which is shorting your small caps, are up. A lot of your oil names here, natural gas names here, and of course your inverse funds. Every name that is shorting the S&P 500, that's shorting the Nasdaq, that's shorting even the Dow Jones, all of them are actually up for the year, albeit very small up on the Dow Jones shorts, with more people making money shorting the Nasdaq, obviously a 54% on the SQQQ. Of course, those who shorted ARK names are very, very fundamentally making a lot of money this year. And you could see that this is the funny thing. Those people who obviously shorted treasury bonds with interest rate hikes going up, and away are up 90% up for the year. So let's just take a look at the S&P 500 constituents, guys. Are you still here with me? All right, you guys are still here with me. Do add some questions on the stream chat. If you have questions, I'll try to answer them if we have time. So let's go on and proceed. Okay, slideshow. All right. Okay, so this year you can see that for the last 2 years, you've got the XLE or the energy names rising 150% as a group. A lot of people were asking how come this year the S&P 500 is just down 15%. It's because of the following thing. The XLE was up 60%, negating or offsetting the declines of your materials, down 10. Your communication, down 37. So communication services here are a function also of your social media names. So social media names are part of communications as well. You've got financials down 11, industrials down 7, the tech sector down 20, consumer discretionary sector, which is your cars like Amazon and Tesla, they're in the XLY, they're down 30% this year. Even your Netflix is in the communication service here, okay? Your streaming related names are in the communication services. Healthcare this year is unchanged. You've got utilities unchanged. Real estate sector is down 20%. You've got consumer staples unchanged. So basically, the reason why your S&P 500 is just down 15% is because your XLE is masking the massive drops happening on other sectors. Now, if you take a look at the of the entire economy, you're seeing in the last 3 years, your S&P 500 is still up 26% over the last 5 years. Your S&P 500 is up 50%. And for those who are saying that the technology sector has gone down way too much, well, for the last 5 years, your XLK is up 100%, which is at outperformance versus your S&P. S&P 500 is up 50, your XLK is up 100, which suggests to us that tech sector actually has a further downfall to go. And your energy is just up 36% over the last 5 years, just actually similar to the rallies made by staples here, when in fact your energy sector names are up 300% in terms of profits, whereas your staples aren't even that big of a profitable in the last 5 years. So XLE against the SPY. For those who are wondering, are you late to buy energy? Let me just remind you that the energy stocks haven't been so cheap. We are still in that 20-year, actually 20-year low was 0.19. We just got about 0.25 in the last couple of months. And we are actually at the point one stage. We were lower than the last 20 years over the last 2 years, i.e., during the COVID pandemic, the world basically thought that when we shut down all of our trains, airplanes, the entire mobility factor, all our cars, you could see that everyone even saw the energy go negative. So that was the lowest time for energy names, only to see obviously that we need energy in our lives. And XLE is still massively underweight when you consider the 2010 and 2015. There is still lots of 100% upside from XLE just from a ratio of the S&P 500. If zero point 0.2 ratio goes to zero point 0.4, that means that a lot of people has still a lot of ammunition to continue buying energy stocks. And if you take a look at energy stock P ratio, they're just 3 to 5 times for the small caps. Mid caps are about 5 to 8 times, and the large caps are just 10 to 11 times. Why is that so? Why are they still cheap? Because the energy profits have been on average up 300% year on year. So people still have not grown their XLE positions over the last 2 years. This is your XLK SPY for people who said Apple has done damage, Netflix has done damage, Amazon, Tesla, Google, Facebook, they've all dropped already. We should start buying. The answer is wrong. You've got the XLK versus the SPY still trading at your year 2000 bubble-licious levels, i.e., people hold their Apples way too much, their Amazons and Tesla. You still have leeway to fall 50% down towards the 2008 to 2010 averages of about 0.2. People still have a very outsized overweight position on technology. And this is still, in my view, one of the best pair trades to make. Short technology, long energy. Short XLK, long XLE. That is still a trade to make for the next couple of years. Now, this is your XLY versus the SPY, consumer discretionary, with a lot of household wealth tied into their cars and their houses. How much more drops can happen here? Well, you could see that the 2009 to 2021, your consumer discretionary items, which were really a function of, well, I want to travel, well, I want to go to this hotel, well, I want to just, enjoy, go to a concert, all of these entertainment factors for people who are wealthy. As a whole, America basically enjoyed that low interest rate economy, and that made consumer discretionary stocks, particularly Amazon, e-commerce names like Shopify, really make a lot of money during that decade. However, the argument is that it's not going to be doing well for the next couple of years, in fact, decades ahead. So the problem here is how much more leeway can XLY fall? And if you just take a look at history, well, we have leeway from 0.4 to go to 0.3 or 0.2. That means that Amazon and Tesla are still not off the hook here. So every Tom, Dick, and Harry still owns, unfortunately, Apple and Amazon, ExxonMobil and Chevron are still under-owned. In fact, how do we know this? They even own more GameStop and AMC rather than energy. This is coming from Robinhood. They're unveiling an index just to track the customers' favored stocks and what they own. This is coming from September 9, 2022. The Robinhood Investor Index tracks the performance of the top 100 stocks owned in aggregate by Robinhood, which is your retail investors. The US retail shows to you the weights of their customers' conviction, whether they have just $20 or $2 million. Now, take a look at the top stocks owned by Robinhood: Tesla, Apple. So we can clearly see here they love electric vehicles. Tesla, Lucid, Ford, and NIO, they love their memes. GME and AMC, they love Disney, Apple, Amazon, and Microsoft. Unfortunately, if you take a look at all of these companies, all of their earnings are actually slowing down. In fact, Disney is bleeding money. AMC and GME continue to be down in terms of profitability. And you've got Apple, Amazon actually hitting negative guidance. So good luck to Robinhood. Looks like they are massively tech focused. No energy stocks at their top 10, which really tells us there's more leeway for Robinhood retail investors to continue getting a beating next year. In terms of weight, then you're seeing there's 75% focused on large cap, and it will not be a surprise that that large cap investment is obviously Apple, Tesla, Microsoft, Amazon. So you're seeing that they continue to own a large majority into your technology names. Okay, I also took a look at a more popular stock. What else do people have in their popular portfolios? We can clearly see that they own a lot of Shopify, Roblox, Nvidia, Zoom. They also own a lot of the S&P 500 ETFs, which is the VU, or the S&P 500 SPY. So if you take a look at the large majority of the makeup, these are all technology names. So technology, communication service, consumer discretionary items, a lot of this has leeway to fall. Just last night or last 2 days ago, Nvidia reported their earnings down 70%. You've got a lot of your Apple iPhone demand also dropping. Inventory is really creeping up in your Target and a lot of your Nike. So that only means that you've got a lot of people with a lot of inventory, and that means that it's a lower price discount. There's going to be lower prices ahead or discounting mechanism, so lower profits for for a 2023 earnings. So initially, you can see that in the Robinhood, their top five is Tesla, Apple, Amazon, Ford, and meme stock favorite AMC. So let's take a look at the previous winners. I can understand why Robinhood loves tech, because they saw that Amazon went from 1999 till 2021. That was a 213,731% gain. So it seems as if Amazon can do no wrong. Take note that it went into a 20:1 stock split. So your $1 went to about $4,000. And yeah, so that's just insane, right? Insanity indeed. So it's no wonder that people just can't get themselves not super in love with Amazon. However, even Andy Jassy and Jeff Bezos has warned the Americans themselves that they have been slowing down those e-commerce and cloud revenues from Amazon Web Services. So Amazon right now has already fallen from its peak of 3.6 to about Amazon right now is at 2,000. However, even at 2,000 or 1,000, we're continually seeing a lot of downside ahead for your Amazon. Your Netflix has gone, actually went as high as $700. It fell to about as low as 200, actually went as low as 168. So, but back then, when streaming was, of course, only monopolized by Netflix, there was no Disney, there was no Roku, there was no Paramount, there's no Warner Brothers Discovery, there's no HBO Max. Basically, all of Warner Brothers and Discovery and HBO Max were the same. But the point is that there was no competition, and Netflix had everything to win. Same case for Amazon, wherein it had no competition. They were the only e-commerce game in town, save for the fact that around 2010, I think Shopify, 2010, was it 2010 or 2011, Shopify came, 2015 for Shopify. It got listed for the market to play the Shopify marketplace for to sell third-party marketplace. So anyway, you can see that these outsized wins from your Amazon and Netflix truly embedded to every American that they should be in technology forever and ever and ever. Now, we argue that we are in a different decade here, and the current winners are actually very clearly. So, I think this Gen Digital is wrong. So this 52x return is wrong. I took a look at the data for Gen Digital. There's a mistake here in the data. I'm using slick charts for this data, but this is correct. Occidental, in your S&P 500 winners this year, your top 30, if you take a look, let's just read through the names. Occidental Petroleum, that's an oil and gas company. Constellation Energy, Hess Corporation, Marathon Oil, EQT Corp, Marathon Petroleum, ConocoPhillips, ExxonMobil, Valero, Schlumberger, APA Corp, EOG Resources, Enphase Energy, Halliburton, Devon Energy, Chevron, Phillips 66, Diamondback Energy, McKesson, Cardinal Health, CF Industries, Archer Daniels Midland, Pioneer Natural Resource, Vertex Pharma, Coterra Energy, Corteva, Targa, Signal, Lockheed Martin, Northrop Grumman, WR Berkeley, Lamb Weston. If there's anything that you will learn from your top 30 companies, number one, they're in the energy space, oil and gas. Yes, you've got one solar company in the top 30, which is Enphase. Yes, you've got a couple of pharmaceutical companies like McKesson. You've got a few of the like Vertex Pharma. You've got a few agricultural fertilizer names like CF, ADM, you've got these defense industries like Lockheed and Northrop Grumman, which tells us that people are spending on defense industries. And you've got some food groups like Lamb Weston. So if there's something to learn from the winners, it tells you guys that the world, it's not me who's saying this. A collective wisdom of the world tells you if you're gonna go long this market, make sure you're long energy. Energy mas happy. For the Filipinos out there, there's a song, mas energy, mas happy, or something like that. That's how your portfolio should look. Mas energy, mas happy. There's a question. Why are REITs so down? Because as more and more people see how mortgage loan defaults are happening, less and less people are occupying offices. They are still doing remote work. They cannot actually pay those office rentals. So the question is, the market still rallying? There's a question, how long can this Christmas rally of PSCI last? Unfortunately, I don't want to time when it's gonna last, but you be careful on December 14. December 14 is Fed rate hike, and the Fed is not mincing words. That's the reason that today's title is, if you F around, you will find out. But let's go through further data that I'm sharing. Okay, so for those who are new here, we have made several fundamental calls saying that oil, SD, CVE, Sandridge Energy on September 22, we made a report here for the Awesome 10X Club. We've got Power of Dividend Investing discussing which companies are paying dividends and are passive income strategies. Obviously, a lot of these are energy and staple names. You've got Vermilion, a utility play, an oil and energy play. We still believe in them. Equinor, Valero, APA. I believe I gave this as a free class on September 16. A name to fight inflation, generate passive income streams. Equinor, Valero, and APA continue to trade near all-time highs. Energy dividend names like Matador, SM, Chevron, ExxonMobil, we kept on saying that even during September, it was not late to keep on buying them. And we discussed how the long-term investors should understand the relentless rules of humble arithmetic. Now, I'm saying that if you believe in investing, long-term index investing, there's nothing wrong about that. Also discuss nuclear energy, uranium stocks. I said that your portfolio should be the best vision of your future. That's been said a lot by motley fools, but my best vision of the future is a World War III, a bleak stagflation, which means that the only assets that make sense is energy, nuclear energy, which is uranium. Perhaps I would believe in some solar names, but overall, your NASDAQ, your S&P 500, your financials are in trouble, and you've got the dollar still on the way up. You should be looking to replace your pesos to the US dollar because a World War III doesn't actually help your Philippine peso. An energy crisis does not help our Philippine economy. We import oil, which means that only the companies who produce energy, which is unfortunately the USA, the China, and the Russia, and the Middle East countries, and the Norway, those are and Canada, yes, those are the only countries with the companies to beat our inflation. Nuclear and solar can save us from further energy crisis, and we have seen growth in renewables saving the Europeans $11 billion in gas imports since the war. This is your year-to-date gains in your energy. Let's go and name them one by one. You've got Energy U up 300% for an obvious reason that it is 3x leveraged, meaning the overall big three is up 100% this year. Which are those big three? Those are your ExxonMobil, your ConocoPhillips, your Chevron. So that is ExxonMobil up 85%, your ConocoPhillips up 80%. Of course, your oil gas explorers are making more money because the more they drill, the more they can produce oil, which is in heavy demand worldwide. Refiners in the Philippines like Petron, they don't make a lot of money because they're simply refining. Refining is different from drilling. Refining only is like whatever oil is, okay, I'll just make a 5 to 10% margin on top of it. Unlike oil, wherein you produce oil at just $35, $40 production cost, some are even producing less than $35, and they sell it at market at $90, at $100. No reason why their profits are up 300% year on year on average. On average. Some are even making 500% profits year on year. So these are your small caps that are benefiting, obviously. Now, which are the biggest losers in the S&P 500 this year? I'll just read to you a few names. Meta, everybody knows Facebook. Facebook is down 70% this year. You've got PayPal down 50%. You've got cruise liners down 50%. You've got VFC down 56%. Bath and Body Works, Match Group down 60%. It just tells you that retail is bad. A few financials are not working out. Streaming, no matter how much we like Game of Thrones, Warner Brothers is down 50%. House of Dragon is spending a lot on content, but the revenues are very low, so they can't actually make some money off of people streaming. And I can understand, a lot of Filipinos, me included, I am not paying Warner Brothers. I'm just still a pirate when it comes to watching these House of Dragon. Okay. Let's go for further assessment. In the USA, your S&P 500 is also up because of healthcare. So healthcare are actually at their 20-year highs. You can see that in the year 2000s and 2010s and 2015s and 2020s, all the last 20 years, everyone, medicine, healthcare is expensive. You've got XLV Holdings, United Health Group, Johnson & Johnson, Eli Lilly, Pfizer, AbbVie, Merck, a lot of Abbott. So basically, Eli Lilly is an example of that perennial pump where you've got this name going from something like less than $40 to as much as $360. Here, if you were able to get it during the 1990s, it was like less than $20. Why is a pharmaceutical company shooting to the moon and all-time highs? Well, Bernie Sanders actually said that Eli Lilly should apologize for increasing the price of insulin, which is really for diabetes patients, by over 12x since 1996. They basically cost less than $10 to manufacture, but they're charging people with diabetes $275. I think I've seen in a documentary that the people who are already sick are just making pharmaceuticals obscenely rich. Instead of saving lives, they have their patents protecting them. Now, Eli Lilly is saying that this is a fake Lilly account. But Elon Musk also said the full answer to insulin price question is complex. The short answer is that the original insulin discovered in 1921, not 1923, is inexpensive, costing as little as $25. Now, higher efficacy analog variants are more expensive. And then Squawk Square answered as well to Mr. Bernie Sanders. He said, maybe the Democrats should apologize to the entire country for raising prices on everything we consume to the highest levels in over 40 years. But I guess you do not want to address that. Basically, Democrats are still allowing medicine to be expensive. So there is definitely a lot of cash flows in your pharmaceuticals. Just by looking in last year's revenue and numbers, there is no question that all the pharmaceuticals are making a lot of money. AbbVie, Bristol, Myers Squibb, Johnson & Johnson, Pfizer. We just even got a government spending on all the COVID vaccines that Johnson & Johnson, Pfizer, Moderna got the government to spend upon. So basically, the pharmaceutical industry is making a lot of money. Now, I'm not saying that these pharmas are going to be down. I think that as long as the government continues to help these pharma to charge high, then you will still have very expensive healthcare since they're very profitable. Now, if you also consider energy stocks and delete it in the S&P 500, you would see earnings in the S&P is down for the entire market. The energy sector reported the highest earnings growth of all 11 major sectors. We're talking about real estate, we're talking about consumer industrials. We talked about these 11 constituents: materials, healthcare, real estate, discretionary, staples, all of that. If you take off energy, your S&P 500 year-over-year earnings increase is simply 30 billion. That means without energy growing $47 billion, you're in a negative 16 billion. So if energy sector is excluded, instead of earning 6%, you're actually down 4%. So energy is the only sector masking the charade in your S&P 500. Now, obviously, the Philippines doesn't even have an energy stock. So we have coal, right? We have Aboitiz Power, Semerara. Those are our energy stocks. It shouldn't surprise you why the Philippines' biggest movers in the PSEI is your Semerara and your what's our energy stock in the Philippines? Aboitiz Power. You've got some solars trying their best to give energy, but I think it's still a pipe dream on whether our solar companies can really address the energy needs of the Filipinos. So energy is still going to be the best sector in the Philippines, in China, and US, worldwide. Worldwide. There's no place to be except mas energy, mas happy. Maybe that should have been my title. Ay, more enervon, mas happy pala yun. Galing talaga nila. But really, more energy, mas happy. Okay, energy of all types. Okay, so as a group, it has been energy that masked your S&P. Now let's take a look at the market breadth. A lot of technicians will discuss, what about the market breadth? Are we rallying in a very good fashion? Okay. One of the best 5 market breadth indicators is how much is the percentage or the number of stocks going above moving averages. Now, if you take a look at the 50-day moving average, as I saw and I shared to you a while ago, it's nearing the toppish level. It's above 50-day, but it's similar to the bear market rally of June 16 till August 16. So watch out on that. Now, how about the percentage or the number of stocks above relative strength 55? Same thing. All are overbought on a 5-day, 10-day, 15-day, 20-day moving average, meaning for the last month, yes, there's an overall rally, but if you take a look on their 125 or 200-day moving averages, they're all on a downtrend. Now, you're also going to share, of course, the periodic highs and lows. What's happening to these stocks near the highs or near the lows? Obviously, if you're taking just a 1 year outlook here, you might be wrong. You might think that, oh, we're at 52-week lows, except that you are at 10-year highs. So if you take a look on a yearly chart, you will be wrong because you're only seeing 1 year. If you take a look, as I said, on the here, what's the level of your consumer discretionary over the last 10 years? On a 1 year statement, XLY seems to be down, right? Right? You're seeing that, wow, XLY, wow, your Amazon is at a bargain price. Haha. No, over the last 20 years, you are still overvalued by a minimum of 30% as an index. How about your technology names? Over the last 20 years, are you getting it cheap? And the answer is a definite no. So it may be looking cheap on a 1 year perspective, but it is very, very expensive on a 10-year, 20-year format. So let's take a look on further market breadth indicators here, your advanced decline and your net new highs and net new lows. So another index that a lot of technicians look at is the McClellan Summation Index. This is a market breadth indicator developed by Sherman and Marian McClellan. This is based on the McClellan oscillator, which basically says that if it is positive, that means it's overbought. When it is negative, it is oversold. It tells you the divergences that you could use. The key takeaway here is that market breadth will look at the change of advancing to declining securities in the market. It can warn of reversals. It can warn of strength or weakness in the index that is not simply visible by simply looking at the chart. It tells you divergences, bearish divergences, the number of stocks reaching certain hurdles, and other metrics. Let me show to you the advanced decline line. We are rising. As you can see, the S&P 500 has gone from 350 to 400. That is a 15% rally. But you can see that our advancers versus decliners are also at a lower high. So every time we rally, we are rallying to lower highs, which tells us that advancers versus decliners continue to be at lower ratios over and over again. That is telling you to remain short and actually have chances to short. If we rally further, it should be a short. Now, this is also another indicator to look at, the breadth or the percentage of shares or stocks above moving average. This tells you a good way to monitor, are you overbought or oversold. Now, if you want to really take a look at trading indicators, a lot of people are doing greed and fear zones. You don't need to be a coder. A lot of people in TradingView are willing to publicize their their codes for free. So this is an example of index breadth percentage of stocks above key moving average. You're looking at the percentage breadth. You're looking at the 200-day moving average, the 150-day, the 100-day, the 50-day, all of these moving averages to share to you how much are the percentage above or below. And looking at the QQQs here, you can see the percentage breadth. We are in the overbought territory. So I overlaid this community script indicator. We are rallying in the index, but the percentage of stocks above moving average is very small if you're going to change it from 50-day versus 200-day. So as usual in a bear market, you do try to rally to the 200-day moving averages, but it's always at a resistance. So this is your S&P, this is your QQQs. We have been seeing overbought signals starting from 284 until 310. So we can rally further for S&P or your NASDAQ, but that is showing to us as here, signs of toppishness. Signs of toppishness here during April. Signs of toppishness here on August, which eventually fell on September. Sometimes it's early, like here at 320, we still rally to 340, but eventually we fall. So here about 284, we can still rally to 310. No questions asked about that, but eventually it does drop all the way down before you get to that oversold region. This is your S&P 500 with the percentage breadth. So I took a look on the NASDAQ and the S&P 500. you are in that overbought region, which tells you that we have to be, in terms of percentage, toppish, hence sell. We are in the sell zone. These are also famous indicators. The advanced decline line calculates all the running total of the difference between number of advancers versus decliners. You've got the new high versus the new low index. We take a look at the 52-week highs making 52-week lows. We can see that a reading below 50% indicates more stocks are reaching their lows compared to stocks reaching their highs, which are signaling moves into bear markets. You can see that our new highs this year are mostly in the energy stocks. Every tech stock in the 52-week low zone. S&P 200-day index, this is the easiest way to detect, are you in a bear market? Are you in a bear market rally? The 200-day moving average is the basic level where everybody looks at on whether a lot of people are losing money or making money. 200-day moving average is as simple as looking, are we below or above? If you are below 200-day, every sector tells you you are in a bear market. If you are above 200-day, you better buy because it is a bull market. Unfortunately, the stocks that are above 200-day, as I said, are war machines. Sure, you can buy all the war machines if you want. So basically, you should be in the agreement that we are in a World War III, or we are preparing for a World War III. And the world believes in high oil prices, inevitable inflation continuing to remain high. The breadth of market theory, you can read it all in Wikipedia, Investopedia. This tells you to assess whether major stock indices are likely to rise or fall. There's no such thing as certainty, but if you've got all the market breadth indicators in favor of saying that this is going to be declining, I think you want to heed into the indicators rather than believing that this rally will continue on and on. This is your on-balance volume. The prices are going up, but the volume is very, very low. You can see very little volume, which is used in technical analysis to measure the buyers versus the sellers. The buyers are buying, but the volume is little versus the sellers. You can go up 100 million shares, but then you get sold 900 million shares. So what does that tell you? Very little volume on the upside, which tells you a very bearish characteristic on this market rally. So you fuck around, you'll find out. What does this mean? This is an urban dictionary. You fuck with someone that you know shouldn't be fucked with, which is the Fed, then you find out why they shouldn't be fucked with in the most painful and humiliating way possible. Just yesterday, November 17, the Federal Reserve officials like Bullard suggest that substantial rate hikes may be needed, that 1 month data point of CPI 7.7 is not gonna stop them from raising rates. The hellish Elmo, of course, believes the world will continue to burn. So this is your S&P 500. By the way, historical moving averages will tell you a minimum recession crash is 35% from the peak before you bottom out. For people who said 3.5 was the bottom, there's no historical precedence on that. Recessions over the last 100 years have said minimum of 35%, as much as 50%, or if we're going to go Great Depression stage, 80%. So minimum is 3.2. Average is 2.4, and anything below 2.4 is overly panicking already. So do you want to fight against a 100-year historical average? I talked about these averages last week. You can go back to my last week when I discussed all these data, statistics. If you are a quant, these are where the long-term recessions go into for a bottom. So just as every long-term dollar cost average touts 10% CAGR, invest 100 years in the SPY, it is undeniable not to tell you that we do not end with a 20% decline in the SPY. The average is 35. That's just a soft landing, guys. A hard landing is 50%. Depression level is 80%. Now, if I'm just a betting man or woman, obviously, a 35% decline is 3.2. The earliest you can bottom fish this market if you want to go bargain hunt for that great millionaire status of yours is number one, watch for 3-2 and then 2-5. Now, whether you can get 1-8 or 1,000, which the doomsday people are thinking of, I don't know. I think Jeremy Grantham is asking for 1-8. And I don't think you can really get 1-8 for the SPY. Now, last night, a few days ago, TJX just posted earnings with profit above estimates, but sales are lower than consensus. And they were able to still grow their inventories from $6.6 billion to $8.3 billion. When your inventory is piling up, that means that you aren't really selling well. It's just that your profits came above estimates because you were able to have a higher margin on whatever sales you are selling. You're seeing TJX companies went all-time highs last night, $78. This is a particular anomaly that I would love to watch for potential short squeeze plays, which we think will go back to 50s next couple of weeks. So we want to watch out for these holiday retail spending euphoria, which isn't actually gonna be sustained. Why? Because of credit card debts. I'm gonna show you the credit card and household spending. So inventories also for Nvidia doubled. We have a short on Nvidia. You've got really bad numbers coming out from semiconductor Nvidia, and yet Nvidia is still at $160. For those who are not aware of the fundamentals, I think that you have to be very careful. Some semiconductors in USA, like Nvidia, is seeing gaming down, data center slowed from 70% growth to 30%, and Nvidia is still trading at 50 times PE ratio and 13 times price to sales. So why is it that these stocks are still going up? Number one reason, options expiry. Probably, but the fundamentals shouldn't be. So you wait for TJX and Nvidia. These are short ideas. Let me show you the charts here. I will also teach you guys how to implement puts. There is a question in the chat. Somebody's asking me, what about Disney? Disney actually is a short at 120. The higher it goes, it is a short. Unfortunately for Disney, it's very clear your moving average here are actually sell areas. Disney, unfortunately, is bleeding money. They're bleeding on Disney Plus, just like HBO, which I like the shows. Guys, I love House of Dragons, but Disney streaming, creating those great shows like Star Wars Andor, does not come cheap. Disney lost money. Unfortunately, that streaming giant is gonna cost Disney quite a lot. Operating profits will become down, $1.5 billion loss, actually, if you took a look at the quarter. So Disney might actually fall from 90s to 80s or 60s. It could rally to 110, but that is a short. Nvidia is a short here. The closer Nvidia tries to rally here at 180s, the better the short position, guys. Nvidia, yes, you heard me right. Everybody loves Nvidia, but it is a short. Okay? Nvidia is a short. We've got these numbers from TJX. It went all-time highs last night, but this is actually a good short setup. Wait for a setup for these. Holiday spending galore. People are buying discounted inventory through what? Credit cards. People in US have never learned. So far, they borrowed $1 trillion, which has a 22% interest rate next year. So somebody's gonna have a lot of questions on where that money to pay that credit card loan, where's that coming from? Let's talk about these numbers here. People, be careful. You've got unsettled geopolitical tensions, check. Elon Musk selling his shares. He's talking about Twitter, but really, even without the Twitter purchase, he will continue to sell his shares. Warren Buffett is selling his shares in some banks. He's selling in BYD. Larry Fink, BlackRock, has been selling shares. Stanley Druckenmiller, one of the best investors and managers of the world, 30-30 track record, 30% gain over the last 30 years every single year. That's a CAGR. Warning a decade of a zero return, 100% likelihood of a recession, 2023. Ray Dalio, principles of changing world orders, resigning, because obviously he thinks that the world is gonna go to shit and he doesn't want to stay on top of his mutual fund, and he'd rather be in a family office because he sees lower returns ahead. Mark Zuckerberg laying off thousands. 11,000 employees, tech stocks dropping 70 to 90% from their peak, but their earnings are also dropping 70%. So actually, from a PE ratio, they're still expensive priced because your earnings are down 70%, your valuations are down, but still your P is just in line with your E. The Great Reset, stock market crashes, wipeouts. You've got balances on the rise, who is taking more credit card debt. Total household debt balances are rising. Largest nominal quarterly increase since 2007. The rise was in an increase in mortgage balances. Your household debt is up 69% in the fourth quarter of 2019. Mortgages are now 71%. The use of credit cards also ballooning. Great holiday shopping season from TJ Maxx. Unfortunately, that was just credit cards, guys. Right now, they're not able to distinguish between borrowers who can repay and borrowers who cannot pay. This is your credit card balances, up 15% on the upswing. We've never seen that level since 2007, and this was what? The prelude to the great financial crisis. Guys, you've got all these data. 2007, credit balance was ballooning. 2022, credit card balances up 15%. A lot of people are using credit card to pay. Now, let's take a look at some numbers here, guys. Household debt soaring at the fastest pace. The fastest with credit card use surges. Every age group, by the way, is borrowing money, whether it be an 18 to 29-year-old, 30 to 59-year-old, 60 to 79. You've got the overall average credit balance up. MasterCard, Spending Pulse, they said that department stores are making a comeback with deals and discounts to entice customers. Guys, MasterCard doesn't care on whether you're swiping and not paying. When you swipe your card, MasterCard and Visa makes money. But who will shoulder that loss? The banks. Eventually, if you do not pay credit card and BDO, BPI, who's gonna suffer the loss? The credit card companies who issue that, which is the banks. If you're asking me why I'm short the banks, because 2008 financial crisis, we saw so many people didn't pay their utang. Utang po. They're not paying. Look at this. They'll buy and buy, but the credit card balance has risen to $1 trillion. That's just debts, credit card debts, mortgage balance. There is also an increase in delinquencies. It's the big short yet again. You are seeing a lot of people borrow money and not paying. Look at this, total household debt reaching 16.5 trillion, mortgage and auto loan originations decline. Are you worried about houses? What would continue to go down and be shorted? Zillow, which is in US, and Becky, which is in China. Let me show to you. They are down, but they will continue to go down. This is Zillow. Any rallies are a short. This is Becky. Any rallies are still a short. We've got real estate and mortgages not getting paid. So what will you have? A lot of delinquent mortgages, a lot of construction not gonna be finished. Okay, let's go ahead for more disappointing data, shall we? Stocks are at a 70-year high as a share of household financial wealth, October 1, 2021. Americans have a 70-year all-time high ownership of stocks at the top. So that definitely affects every spending going forward. Somebody asked me a while ago, what do you think of Disney? Unfortunately, with people not even having money to pay rental, what tells you that they'll go to a theme park next year? Or to a concert? Or to a cruise line? Or to even travel? You think that the banks will really allow your credit card debts to continue going up and up and up and you're not paying? Every spending will fall going forward. And these people who own stocks at a 70-year high, if they haven't sold, well, continually go down. The lower end market is already eating into their savings. Walmart said they grew sales from how? Rich people went to the lower end. People from high income, $100,000 annual income, are shopping on Walmart, giving the retailer a boost ahead of the crucial holiday season. What does this tell me? The pizza pie of consumer spending is shrinking. Walmart simply had a larger share of the smaller pizza pie. If the world is so happy about Walmart taking market share because many rich consumers are now shopping from them, all this means is that the rich people are going to be middle class or poorer next few years. 75% of the market share gains in Walmart came from people with households earning more than $100,000. There's a migration towards cheaper goods. So basically, Walmart is now the place for rich consumers who are no longer rich to shop. So Walmart beat earnings, CP, right? But you ask me how. Rich people are now poorer. They're now shopping in Walmart. Can you believe that? So therefore, Walmart trading here at about $160 is a massive short. Just like TJ Maxx. Walmart and TJ Maxx going up all-time highs. Oh my gosh, more poor people in the world. Everyone obviously likes Buffett. Everybody likes energy. Occidental happens to benefit from everything. So if you want to go long, consensus buy is energy, right? But who cares? People said, I want to be different. Everyone's long energy. I don't want to go long energy, Nikki. Who cares? By being different, you're wrong. The right place to be is more energy, mas happy. Long on XLE is still correct. If it goes $60 or $50, go long Occidental. Go long oil plays. If it goes down here, when it was 40 and 30s, that was an opportunity to enter. If it goes down to 60s, 50s, 40s, continue to go long oil and gas exploration. Americans already have a mountain of debt. This is mountain peaks. Mount Sierra, Mount Apo. Ano ba mga mountain ng Pilipinas, guys? Lahat ng mountains of debt. Smoky Mountain. Total outstanding credit card. A pile of shit, guys. 1999 to present. From $500 billion of utang. In 07, it was 900 billion of utang. 08, syempre, nag-crash. Hindi na sila pinautang. What do you think will happen here? It will be utang ng 1 trillion, tingin mo mag 2 trillion pa yung utangan na yan? We'll see, guys. Pero the more utang, the more problem. Look at the average credit card accounts, 22%. A lot of credit cards, interest rate. Now, Americans love debt. They love utang. Filipinos also love utang. Now, buy now, pay later is buy now, pay never. That's why a firm already was sold down 90 to 95%. You think that buy now, pay later is gonna be like a prelude to the banks? Yes. Let's show to you the charts. A firm business model is now in trouble because mababankrupt. Ang daming pinautang na hindi naman magbabayad. How about the banks? You think the banks are safe? XLF rallying 36 here? This is a short. This is a short. This is a short. Tingin mo yung mga nangungutang sa bangko magbabayad, guys. Babayaran ba nila yon kung nawawalan nga silang trabaho, guys? Vermilion is a buy. We said that energy names are a buy. Dips on Vermilion would be a buy. Here about 17 is a buy. We can see the chart here on Vermilion. 17 to 24. Eventually, it will go up. So 17 areas for Vermilion is a buying opportunity. Okay. traditional banks are in a problem. Of course, Square has a problem because Square acquired Afterpay. The risk of BNPL is on the rise. A lot of people are afraid that these people will not pay, not shop anymore, or whatever they're shopping, they can't pay. So balances have been increasing, obviously, in low-income areas. The reason why Upstart and Affirm were massively sold off because they were giving credit history to people who probably shouldn't be given credit at all. So that's one. Okay, so this is your JP Morgan Fed rate hike expectations. JP Morgan believes that December 14 will have a 75 basis points 75 basis points hike, and then another 40 to 50 basis points hike. So whether it's 75 or 50 doesn't really matter, or 25. The point is that interest rate will continue to go above 5, 6, 7. So that's your interest rate hike probabilities. JP Morgan obviously is making a lot of money from stupid people making their money just in CASA, cash and savings accounts. You can see that JP Morgan earned more than $50 billion over the last 3 quarters. Why? Because of net interest gains. The more that the Fed keeps on hiking rates, the more they're not paying you any interest. Who's making that $50 billion? Is it the JP Morgan customers? Nuh-uh. It's JP Morgan making $50 billion. Now, how about the Philippine banks? Did BDO give you an interest rate? Nah, it's BDO making that money. If you're so stupid not to earn 5% when the Fed interest rate is raising those rates, do they care? No, they don't care. It's up to you to put your cash in time deposit. If you don't care, they'll earn that interest themselves. Okay, there's a lot of things that I want to share, but I don't have time. I can see that I am past my 1 hour line. So, to end my note, let me say to you guys that nobody cares about your finances except you. Don't panic. You can save your finances and profit from market crashes in this worldwide recession. Let me invite you to come on November 26th. Meet up face to face. Those Awesome 10X members who are already members, you don't need to pay. Just come. Let's have coffee, drink, design story in 3 Squares Bar and Cafe. That's in Makati. That's a very nice place, Caravan Plaza. Go there. Register here, that bit.ly/awesome10x inner circle. I'd love to share how there's so many insider selling happening in certain names, and I'd love to explain more short ideas for you. Obviously, you've already heard my longs, which is an obvious energy. But I'd love to share everything. If you have questions, let's go and meet each other November 26th. 9 to 12 a.m., 9 a.m. to 12 noon, and let's discuss the market. Lastly, if you F around, you will find out. See you. Hope to see you guys November 26th. That's a Saturday, face-to-face. And if you're not able to meet me face-to-face, I'm of course open online. Friday is a free Friday class. I'd love you guys to share, like, subscribe. It's for free in YouTube. Now, you can also follow me on Twitter at FacesTrader. That's also for free. I'd love to also discuss a lot of things. S&P 500, how to look at the market breadth, how to look at the constituents. And if you are shorting the market, hold on to your shorts. Thank you very much and goodbye.